Welcome to the Keiser Report. I'm Max Keiser. A fool and his money are soon parted. Stacey?
Max, we're going to apply this to an entire nation, the fool nation that is America, and they are being parted with their money. The first headline reads, Underwriting the Next Housing Crisis. This is from the New York Times. And yes,
talk on it.
It appears
talk on it.
The do-gooders, the well-meaning people perhaps, are underwriting the next crisis. So, you know, we brought in all sorts of new regulations, or the legislator did say, of course, that they were going to bring in things like Dodd-Frank, and they were going to increase standards for mortgage lending. Well, in fact, the regulators had wanted a down payment of 20%, a good credit record, and a maximum debt-to-income ratio of 36%. But under pressure, they dropped the down payment and good credit requirements and agreed to a debt-to-income limit as high as 43%. The regulators believe that lower underwriting standards promote home ownership and make mortgages and homes more affordable. The facts, however, show that the opposite is true.
Well, you know, Stacey, as I've said, I don't know if I did on this show or not, but I have made the point that, you know, during the last Great Depression, a game was invented called Monopoly. Now, think about it for a second, because Monopoly, nobody works at Monopoly. You just sit around the board game, and the bank gives you everybody a bunch of money. And then they give you a piece to chase around the board. Every time you pass go, you get more money. There's quantitative easing. There's quantitative easing every time you pass go. And it's a real estate speculation game. And in the end, there's one person, after being a rent-seeking, rent-charging oligarch, ends up with all of the properties. Everyone else is bled dry. No matter the fact that they were getting money the whole time, the quantitative easing was being paid out the whole time, the asset price inflation of those houses and hotels on the Monopoly board reached astronomical levels, bankrupting the entire board. There's only one winner in the game of Monopoly, and this is exactly what we see in today's Western economies and economies around the world. It's free money from the Fed. People get a free entree through their credit card or whatever means. They race around these boards over and over again, but only one winner. And that winner usually, as we now know, is because they have engaged not with the luck of the dice, but more in terms of the kleptocratic overtures made surreptitiously to a corrupt and venal political class, whether it's Osborne here in the UK or Wall Street bankers.
Well, yeah, and it's politicians seeking to get elected by, encouraging the biggest fools to vote. And the biggest fools vote based on Osborne, say, giving them 20% of their deposit for a house. In the U.S., what they're doing is, by reducing the standards for lending, what you're doing is just making housing more unaffordable, because if somebody can only get $10,000 together for a deposit, and say the deposit standards were 10% of the home price, they could only afford a $100,000 home. But if you reduce it to 5%, then they could afford, theoretically, a $200,000 home. So you just increase the prices of homes for everybody in the environment, but incomes aren't going up. People still can't afford the home. And in fact, the article points out that in the US, they show this huge drop in affordability across America since lending standards were reduced over the decades. And they say in the late 80s and early 90s, down payments were 10 to 20%. The home ownership rate was 64%, about where it is now. And nearly 90% of housing markets were considered affordable. That is, home prices were no more than 3 times family income. By 2011, only 50% were considered affordable, and by 2014, just 36% are affordable, even though down payments as low as 5% are now common.
Right, so all these tricks that they use to encourage people to get on the so-called property ladder are just actually trickling down to the 1%, and you end up with a city like London where you've got oligarchs who are controlling the top properties. They charge exorbitant rent. The rent's going up. So just like in the real economy, people say, you know, there's both inflation and deflation. Again, it's like Monopoly. There's inflation in the value of the real estate that you're landing on as you go chasing around the board, and you have to pay more and more of your cash to these corrupt oligarchs who own these properties. But there's also deflation in a sense that you're going bankrupt. So you have this wide-scale bankruptcy going. When you start the game Monopoly, everyone in the game is going to be bankrupt except for the one person. They are experiencing asset inflation. Everyone else is experiencing bankruptcy and deflation. what if we turn on the BBC any given night or any major news channel? They say economists are confused because we have both inflation and deflation. Well, just look at the game of Monopoly. It gives you the exact analog of what this economy is all about. Free money going around a hamster wheel until one is the ultimate winner. And unlike the game of Monopoly, though, instead of just simply starting a new game, you'll have, like we see in Ireland, 100,000 people on the street protesting against this sudden water tax or water charge. I mean, that ends up going in a place that's not just restarting the game. That's more of a revolution.
Well, in fact, we haven't been restarting the game. What we do is just restart a new Ponzi scheme, a new debacle. That is the housing crisis is what caused the whole crisis. Well, on top of that, we have another investment scam, another Ponzi scheme, another sure way to lose money. And apparently there are a never-ending pile of fools willing to pile in on this, and that is drillers piling up more debt than oil hunting fortunes in shale. So a decade into a shale boom that has made fracking a household word and Floyd Wilson a rich man, drillers are propping up the dream of U.S. energy independence with a mountain of debt. As oil production hits a 28-year high, investors and politicians are buying into the vision of a domestic energy renaissance. So they're focusing on this guy, Floyd Wilson, who's the CEO of Halcon. He's made a lot of money in fracking in the past, and now he's a CEO of this new company. And they say that companies are paying a steep price for the gains. Like Halcon, most are spending money faster than they made it. An average of $1.17 for every dollar earned in the 12 months ended on June 30th. Only 7 of the U.S. firms listed in Bloomberg Intelligence's E&P index made more money in that time than it cost them to keep drilling.
We've been talking about this for a couple of years now. The economics of the fracking industry are hellacious. It costs more then you profit. You can't continue a business like this. The only thing that's increasing is the debt load.
Exactly, and it's all junk rated, by the way. They're financing all of this debt with junk bonds. So they mentioned that they owed $190.2 billion at the end of the June, which is up from $140 billion at the end of June 2011. So,
well, again, this is what happens when the central bank brings interest rate to zero. So here you have a junk-rated paper based on a fracking industry that's not profitable, that can only go one way, and that's into the toilet. But the stockbroker that calls up the pension fund that needs 6 or 7 or 8% to give their retirees the guaranteed income that they signed on to on the annuity or some other contract, they'll buy this junk on this fracking industry. Of course, it's going to go bankrupt, and the pension scheme will go belly up, and then you'll have a whole bunch of people on the street saying, oh, I lost my pension, and then the government will say, well, you win some, you lose some. We engineered the crisis. We supported the frackers. We knew it was economically unviable. We don't have any responsibility for your pension, even though we give it a AAA rating, and, you can go pound sand.
Well, these are junk bond rated. They're junk rated. So what they're doing, of course, a lot of the subprime mortgage in the original subprime mortgage crisis were junk rated as well. But the CDO, they were packaged into CDOs by the likes of Goldman Sachs, and then they were sold to pension funds. So there will be a layer of fraud within this. They're not directly selling to pension funds, but of course, pension funds will be those that owe it. And now one of the things that they're able to get away with, how they keep on raising money, is you have the difference between proved reserves and resource potential. So the SEC itself, if you go to the SEC, but most investors, most fools don't want to hear the bad side of the story. So they will not go to the SEC and look at the actual filings with the SEC. The SEC forbids companies from making resource potential claims in official reserves reports to them. However, the agency doesn't regulate what companies say at investor conferences, in press releases, or on their website. No one does. So they're allowed to say their resource potential, and it would often be 66 times more than what they report to the SEC for their reserves. But discrepancies between proved reserves and resource potential are common in the industry, and investors can get duped, said Ed Hers, a managing director at Houston-based Hillhouse Resources, an independent energy company who also teaches energy economics at the University of Houston. He says, quote, there's a lot of ways to make money in the oil and gas business, and not all of them involve drilling for oil. You just drill investors' pocketbooks. When investors are willing to throw money at you, you can just make money on that. It's a time-honored tradition.
Well, it's been true for 20 or 30 years. But in the oil industry, there is some economics to the oil industry. It is a highly dense material that does have a potential as an energy source greater than the whale oil that it substituted, 100 years ago. But in the fracking industry in America, in fact, the density of that as an energy source is almost non-existent. The costs are beyond exorbitant. The risks are titanic. And of course, as you point out, people buying these projects never look at the prospectus, where the SEC requires the actual provable reserves, not the probable or the estimated or the I'll pick a number out of my ear reserves. Nobody looks at the prospectus. When I was working on Wall Street, the saying was, if anybody looked at prospectuses, if hookers had to show clients prospectuses, nobody would get laid. I mean, that was kind of a crude version of this story, but nobody looks at the prospectus. Nobody looks at what the SEC is actually required to include as the actual numbers, because they're sold these products by salesmen who are completely unregulated, who call up these pension funds and they'll say, you need, here's 4%, it's junk. But and then they'll pull in a wild card. They'll say, like, I don't know, I'm not so keen on buying junk. And then the salesman will say, you don't want those terrorists to win, do you? You don't want the terrorists to win. You better buy this fracking junk bonds, or the terrorists are going to win. And pretty soon it's all about fighting the terrorists, and then you got some poor pension fund manager like, okay.
Yeah, but these are at investor conferences, which are very often held in Vegas, by the way, in places like that. So people are drunk. They're
known for prostitution. Again, if they carry prospectuses, Vegas would die.
Well, and the same thing, again, it ties in exactly with these lowering standards for the, government-backed loans, the Fannie Mae, Freddie Mac-backed loans for mortgages in America. They're reducing that. If anybody actually looked at it, they would realize it's all going to pop. Here in this story, they do interview a guy, a money manager, Tim Gravamovich, who says, I have lent money to nobody in this space, and I don't plan to. The thing is absolutely going to blow sky high because, of course, he's an investor who is, doesn't want to lose his own money. So he looks at the SEC reports and he goes, whoa, this hooker is ugly. And that's why he doesn't buy it. But the people at investor conferences who want to feel patriotic, who want to feel like we're the Saudi Arabia of America, they're going to buy it. And, well, fools and their money are soon parted.
No amount of lipstick in the world is going to make that pig look, attractive. All right, well, we got to go.
Oink, oink.
All right, stay tuned for the second half. A whole lot more. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Dominic Frisby, author of this new book, Bitcoin, The Future of Money. Welcome back to the Keiser Report.
Thank you very much. And you said it with a rising inflection, with a question mark at the end, which is exactly how I intended it to be said. So well done.
It's grammatically correct the way I said the title of this book, The Future of Money?
Yeah, it's absolutely right. But most people go, the future of money. And I'm not saying that. I'm saying it with a question.
Well, it's a timely book. And in the book, you actually name Satoshi Nakamoto. I mean, there was a huge Newsweek story last year or a few months ago talking about this. And there was an outcry and a big storm about this, but it proved to be a false lead. The gentleman that was fingered in that piece. Here you do...
He was fingered in that piece.
That's a colloquialism, a figure of speech. And here you do mention someone... Who do you mention? Who's your...
Well, he is a shy, retiring computer coder from California, from Silicon Valley. I'm not going to say his name.
It's in the book.
It is in the book.
What page? I'll say it.
Okay. Well, it's on. Well, I'm being all shy. Okay, you
Why?
say it.
Well,
I'm not. The one thing you do with when you're looking for Satoshi is everyone who's gone on the hunt has said it with like total. This is definitely Satoshi.
Yeah.
And so I do it with a certain amount of humility, if you like.
By having me say the name instead of yourself.
No, because I'm not
like
going,
this
is Satoshi, but I'm pretty sure it is.
You're outsourcing your disgraceful violation of this man's privacy through me. Thanks so much, Dominic.
I've actually been in contact with him and we've exchanged emails, and he's very nice about it.
Now, this book, I should mention, was crowdfunded on a UK crowdfunding site.
It was. let me just come back to the thing. I spend a lot of the book on this subject. I've analysed everything he's written. I've analysed his past. I've looked for people who fit the criterion, and I've concluded that there is only one person in the whole world that has the sheer breadth, but also the specificity of knowledge, and it is this chap, this Shire.
Okay, so the name Nick Szabo.
Szabo.
Nick Szabo.
Yeah,
Nick Szabo is Satoshi Nakamoto.
I think so.
In your knowledge, in your
Yeah.
research, and
But we should all leave him alone.
yeah. Well, but this is named in the book, and there
Yeah.
doesn't seem to be any kind of firestorm in the Bitcoin community
Because I haven't
whatsoever.
I got obsessed with it, and I had to find out who he was. And then I found out who he was, and then I kind of thought, well, actually, he wants his privacy. It's a bit like, but I do kind of think in a way we need to know who he is, because Bitcoin's grown so big. It's a bit like he controls about 10% of all Bitcoins. He controls where a lot of money goes. And so it's a bit like, I don't know, knowing that Steve Jobs is the man behind Apple or something like that. You do kind of want to know. But at the same time, he wanted to stay anonymous. For
All right,
all
now
sorts of
it
reasons.
says here in the flyleaf of the book that Bitcoin will do to banking and finance what email did to postal service and what the internet did to publishing, destroy old monopolies and create opportunities for the masses. Are we on track for that?
We are. I think Bitcoin's gone to sleep a little bit.
Why?
I don't know why. Bitcoin has these kind of flurries of interest and then these long drawn-out periods of...
But it had
where
some
people-
incredible scandals. The Mt. Gox scandal,
Yeah.
the Silk Road scandal.
Yeah.
And so the public relations department of Bitcoin is... Maybe if there was more of a we knew who Satoshi was, they could hire a proper public relations department and
Maybe.
promote it better. Because otherwise it's in the hands of these hooligans and ghouls. Whether it's...
Well, I think the world has gone to sleep about Bitcoin, but the technology will definitely change the world, and it will do the whole thing of disintermediation because what people are doing, they've kind of gone. We've taken banks and governments away from the creation and the transfer of money. Now they're going, what else can we disintermediate? So it's not just money. Everything from email to, to social networking, to YouTube, to financial markets, to stock markets. The technologies, even the entire way the internet works, we're just going to see middlemen disappearing or new kinds of middlemen emerging. And so it is incredibly revolutionary.
Okay, so now you came to this more or less as a newbie. So you're a journalist and a writer,
Yeah.
and you've been following finance and markets from Money Week and other publications
Yeah.
for years. And so you heard about Bitcoin, you decided to do a proper investigation, and
Yeah.
a proper book about it. What was the most startling thing that you found out about it?
I didn't realize how good it was. And I didn't realize how clever it was. And I didn't realize what an incredible breakthrough it is. And then the next thing that's kind of blown my mind, apart from this revelation of Satoshi and what an incredible genius he is, and my goodness, history will look back at this guy in the same way that it looks back as, the man who invented the internet, who, by the way, is from the same part of town as me, Wandsworth.
Wandsworth, huh?
Yeah.
So Dominic Frisby and the www, internet.
Yeah, but the real revelation was what this technology of disintermediation, what it's going to do to the world.
Right. So we already see it having profound impacts on things like in the remittance business.
Yeah.
The money, moving money around the world for workers who are making quite low wages. And,
Yeah.
and when they send money back to countries in Asia or Africa, they're charged quite a huge sum from their money transmitters from Western Union and others. And here with Bitcoin, it's all down to zero. So this is having a profound impact right there, right?
Yeah, I mean, I had to move some US dollars back to the UK only 2 weeks ago, and it was done through HSBC, and I got absolutely more than fingered, as you put it.
They
And I wish I'd
charge
done
a
it with
fee,
Bitcoin.
and then they charge the spread.
The spread was what killed me.
Right. So they are, there was a
About
scandal.
2% of what the actual Forex rate was.
Right, so there's a 2% on top of the fee and then a 2% gap. And then when you're talking about amounts of $100 or $500 or something like this, which is a typical remittance amount, it comes out to an extraordinary amount of money.
Yeah.
And they, there was a scandal a few years ago when I think it was MasterCard or Visa, we had an insider on the show. It may have been actually somebody who was the first to tell us about Bitcoin. I'm not going to mention his name because he is an insider.
Yeah.
But he said he used to work for one of these big credit card companies, and at the end of the quarter, if they needed to juice their quarter, they would just amp that spread from 2% to 2.5% on any given day. So people are, tourists and their credit card in the machine getting cash, for that day they needed to make their number for the quarter, so they just amped the spread.
Well, that is just outrageous. I mean, it's just terrible. But what's interesting, the credit card company, in the early 90s, there was this big battle as who's going to control internet payments. And it was a big battle between the credit card companies and this thing called DigiCash, who, by the way, Satoshi worked for in the 1990s, interestingly. David Chaum's thing. And because Chaum's technology was actually better than what the credit card companies were offering, but because of various complications to do with egos and wrong choices made at key times, the credit card companies won that battle. But there's no reason why Bitcoin or some follow-on can't win the next battle.
Well, Jamie Dimon over there at JP Morgan made the comment recently that, well, Bitcoin's trying to eat our lunch. And, so he's openly saying, look, they're competing with us, and so we're going to fight back. So when they've poked the hornet's nest with the banking establishment. They realize this is a threat, and they're using all their might to fight back.
Yeah.
They're using their control of the regulators, the control of the markets, the control of the media to do what they can to beat back this threat from Bitcoin. And at the moment, given the transactions are down overall, the mentions of it on let's say, Google search as using a somewhat crude but nevertheless revealing way to gauge interest have fallen down sharply. And so my opinion is that the adoption of Bitcoin is going to be driven by bank crisis, and that we saw this in the crisis in Cyprus. But at the moment, the dollar is high, the banks are fat, people are stocks at a new high. So there's no need for an alternative currency.
I would completely agree with that interpretation. At the moment, the world has lost interest in Bitcoin, and it will take another crisis or a mini crisis to get people interested in it again. But it is characterized by these, as I say, long periods of neutrality, I don't care, and then suddenly these sudden spikes.
Well, we should mention that underneath all this, in the VC community, the amount of hundreds of millions of dollars that are not going into startups is tracking a similar path to the early internet days.
That's absolutely right.
So folks like Mark Andreessen over in Silicon Valley, who's a big macha, dude. I don't know if you use this phrase here in Britain, but it's a kind of a Yiddish phrase we use in New York, a big macha.
I've never heard it before, but I like it. A big macha.
You learn this when you
like a big mama
in New York. And so he's behind a lot of these startups, and they're putting a lot of money into it.
Overstock is his company, isn't it?
No, it's Andreessen Horowitz. He's a VC now. He started Netscape. He created Netscape, the browser.
But isn't he listing his company on the stock market via issuing shares in his company?
So that's overstocked by Byrne.
Okay.
He's now decided that he's going to be a full-on Bitcoin supporter. He wants to take the blockchain and create a stock market, because he got screwed over the years by short sellers who took his company Overstock down to pennies, and through massive bear raids of printing stock, on naked short sales.
Yeah.
And I used to follow Patrick Byrne closely years ago and trying to give him as much support as he can to fight against the short sellers, the naked short sellers.
Yeah.
And now with Bitcoin, he realized the penny dropped, and he said, you know what, I can compete with Wall Street and create a parallel stock market and just screw these guys unmercifully. And so that's what he's now in the process of doing.
Okay.
So he should read this book. Everyone should read it. They should buy this book on Overstock.
Yeah, there you go.
They should sell these. Patrick Byrne, you should order 100,000 copies and give it away to everybody in your organization, Patrick Byrne, if you're really into Bitcoin. I mean, I had him lined up on this show, and then he went off and did another show, even though I'm the only one that supported him over the years. So I don't know who this guy's loyal to, but if he's really interested in Bitcoin, Patrick.
So this is I think it is the first book on Bitcoin by a proper publisher, and I'm hoping it will be, I've written it as engagingly as I possibly can, and I'm hoping it will be the Bitcoin book.
Right. Well, what about your comparison, as you make and others have made, Bitcoin to gold? Gold, talk about that.
Well, if I'm right about Satoshi, he was a proper old gold bug, and he was obsessed with gold. And he thought, he wrote a paper on gold, and indeed money, and he was trying to replicate the process of mining gold with his process of mining Bitcoins. So, for example, the first Bitcoins were easy to mine, they were cheap to mine, they required very little processing power. Surface gold is easy to mine, and then once you start going underground and the mine gets deeper, it all gets much more complicated and expensive.
So gold is trading down as well in dollar terms.
Yeah.
And because the dollar is making this huge run.
Yeah.
My contention is that Bitcoin is suffering from this as well, that
Yep.
gold, silver, and Bitcoin are trading down against this resurgent dollar.
All alternative asset classes, unless they benefit from financial aggression, creation, all this money creation that's going on, all those alternative asset classes, from oil to gold to Bitcoin, they're all dead in
But
the water
now,
at the moment.
though, we have about 20 seconds left. You made a comment earlier about London real estate. It appears to have topped out. Foxtons, the realtor, the property manager, their stock is now below where it went to IPO.
Everyone who owns
underwater.
Foxtons shares is losing. Anyone who's bought a Foxtons shares since they were public has lost money.
Okay, so that's a sign of property possibly topping, and then therefore we could see a reversal of everything in the last few years. All right, on that prayer, Dominic, we must say goodbye. Thank you.
My pleasure, Max. Thank you very much.
All right, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Dominic Frisby, author of this new exciting book, Bitcoin, The Future of Money. If you'd like to get in touch, tweet us at Keiser Report. Until next time, bye, y'all.